Marcus was 27, earning a solid income as a project manager, and had $4,200 sitting in a savings account earning almost nothing. Every day at lunch, his coworkers talked about stocks. Apple this, the Fed that, the market is up, the market is down. And every day, Marcus smiled and nodded. He had no idea what any of it actually meant. He didn't know how to buy a stock, who sets the price, or what the stock market even really is. Today, we're going to answer every one of those questions, from the ground up.
So what is the stock market really? At its core, it's a marketplace, just like a farmer's market or an online store, except what's being traded are tiny ownership stakes in companies. When a company wants to raise money, it can sell shares of itself to the public. Investors buy those shares, hoping the company grows and their stake becomes more valuable. In the US, the two biggest exchanges are the New York Stock Exchange and NASDAQ. The NYSE trades stocks like Coca-Cola and JP Morgan. NASDAQ is home to tech giants like Apple and Google. And this all happens officially between 9:30 in the morning and 4 p.m. Eastern, Monday through Friday.
Here's what really clicked for Marcus. Stock prices aren't set by some authority. There's no committee deciding Apple is worth $180 a share. The price is set by supply and demand, the same force that makes concert tickets more expensive when everyone wants to go. If more people want to buy a stock than sell it, the price rises. If more people want to sell, the price falls. What drives those decisions? Earnings reports, economic news, interest rate changes, and yes, human emotion. Fear and greed move markets just as much as spreadsheets do. That's why the market can feel chaotic. It's millions of people making decisions at the same time.
Now, here's something Marcus didn't expect. When you click Buy on your brokerage app, you don't always buy directly from another person. Enter market makers, firms that stand ready to buy or sell a stock at any moment, ensuring the market stays liquid. They post two prices, the bid, what they'll pay to buy, and the ask, what they'll sell for. The difference is called the spread, and that's how they make money. All pending orders sit in what's called an order book, a running list of who wants to buy or sell at what price. When a buyer and seller agree on a price, the trade executes automatically, often in milliseconds.
This is the chart that changed everything for Marcus. This is the S&P 500, an index that tracks the 500 largest publicly traded companies in the United States. Think of it as the report card for the overall U.S. stock market. What you see here is roughly 25 years of history. Notice those dramatic drops: 2001, 2008, 2020. They look terrifying when you're living through them. But zoom out, and the story becomes clear. Despite every crash, every recession, every panic, the long-term trend has historically pointed upward. This is the foundational data point behind long-term investing. Historically, the S&P 500 has averaged around 10% annual returns, though past performance never guarantees future results.
10%. That's the approximate average annual return of the S&P 500 over the long run, based on historical data going back nearly a century. Now, no year is exactly 10%. Some years the market is up 25%, some years it's down 30%. But when you average it all out over decades, the number has historically hovered around 10% before inflation. For Marcus, this was the moment everything clicked. His savings account was earning 0.4%. The stock market, historically, had returned about 10%. He wasn't being asked to gamble. He was being asked to understand how the market actually works before choosing to participate in it.
Marcus used to think stock prices moved randomly, but there are patterns. This chart compares some of the major forces that drive daily market movements. Earnings reports, when companies report quarterly profits, are the single biggest driver of individual stock prices. Economic data, like jobs reports and inflation readings, move the broader market. Federal Reserve interest rate decisions affect everything from mortgage rates to how much growth stocks are valued. And geopolitical events, wars, trade disputes, elections, can shock the market in either direction. Understanding these levers doesn't mean you can predict the market. It means you understand why it moves the way it does.
You've probably heard the terms bull market and bear market. Here's what they actually mean. A bull market is a period where stock prices rise 20% or more from a recent low. Investors are confident, money flows in, prices climb. A bear market is the opposite. Prices fall 20% or more from a recent high. Bear markets feel brutal while you're in them, but historically, every single bear market has eventually given way to a new bull market. Somewhere in between, you have corrections, drops of 10% or more. These happen fairly regularly and are completely normal. Marcus needed to understand this cycle before making any investment decisions. The market isn't broken when it falls. It's functioning exactly as it always has.
So, how does someone like Marcus actually buy a stock? It's simpler than most people think. First, open a brokerage account. Fidelity, Charles Schwab, and Vanguard are well-known U.S. options. Fund the account with a bank transfer. Then search the ticker symbol. That's the short letter code for a company, like AAPL for Apple or MSFT for Microsoft. You'll choose between a market order, which buys immediately at whatever the current price is, or a limit order, where you set the maximum price you're willing to pay. With Citrine Executes, you're officially a shareholder. You own a piece of that company. That's it. The intimidating jargon disappears pretty fast when you see how the mechanics actually work. Here's a stat that surprises most people. According to Gallup's 2024 data, about 61% of Americans own stocks in some form, whether directly through a brokerage account or indirectly through their 401k or IRA. That means if you have a retirement account through work and it's invested in mutual funds, you're already participating in the stock market. Marcus realized this when he checked his employer's 401k. He had been invested for 2 years without fully understanding what that meant. For the remaining 39%, understanding how the market works is the first step toward deciding whether and how to participate. This video is for educational purposes only. Always consider your own financial situation before investing. 6 months after that lunch conversation Marcus used to dread, he opened a brokerage account, contributed to his 401k, and finally understood what his coworkers were actually talking about. He didn't become a day trader. He didn't pick hot stocks. He just learned how the system works, and that knowledge gave him confidence to take his first step. The stock market isn't a casino for insiders. It's a structured marketplace with rules, participants, and historical patterns that anyone can learn. Prices are driven by supply and demand, company performance, and economic data. And historically, patient investors who understand what they own have been rewarded over the long run. Now you know how it works too.
Everything you've seen in this video is for educational purposes only and does not constitute financial advice. The stock market involves real risk, and past performance never guarantees future results. Please consult a licensed financial advisor before making any investment.